Is it possible to get the safety of an ETF and still get the potential upside of higher yielding stocks? In this video, we'll compare exchange-traded funds, or ETFs, with investing in individual stocks when focused on dividends. We'll look at the differences in the two approaches and how to get the best of both worlds.
I'm so excited!
We're talking stocks versus ETFs in today's edition of Constant Cash Flow. Welcome to Constant Cash Flow. I'm Jonathan, and I talk about creating passive income to make your time and money actually work for you. Smash that like button, subscribe, and click the bell for notifications so you don't miss any upcoming content. When you subscribe, also drop a comment saying I subscribed. I give a shout out to random subscribers each week in my Sunday video. Now, let's get back into it. So what exactly is an ETF, and why are they so popular?
Okay, explain.
An ETF is an exchange-traded fund. It's a type of security that tracks an index, sector, commodity, or another asset, but which can be purchased or sold on a stock exchange the same way a regular stock can. An ETF can be structured to track anything, from the price of an individual commodity to a large and diverse collection of securities. ETFs can even be structured to track specific investment strategies. One well-known example is the SPDR S&P 500 ETF. Ticker symbol SPY, which tracks the S&P 500 index. ETFs can contain many types of investments, including stocks, commodities, bonds, or a mixture of investment types. An exchange-traded fund is a marketable security, meaning it has an associated price that allows it to easily be bought and sold. The price of an ETF shares will change throughout the trading day as the shares are bought and sold on the market. This is unlike mutual funds, which are not traded on an exchange and trade only once per day after the market closes. For this reason, ETFs tend to be more cost-effective and more liquid when compared to mutual funds. Although there are many different types of ETFs, today we're going to focus on ETFs that track stocks and specifically stocks that are focused on dividend returns. Some of the more popular dividend ETFs are VIG, which is the Vanguard Dividend Appreciation ETF, SDY, which is the SPDR S&P Dividend ETF, SCHD, the Schwab U.S. Dividend Equity ETF, Noble, the ProShares S&P 500 Aristocrats ETF, and SPHD, the Invesco S&P 500 High Dividend Low Volatility ETF. Now, let's take a look at each one.
Let's go get some answers.
VIG, or the Vanguard Dividend Appreciation Fund, has a dividend yield of 1.55% with a 5-year CAGR of 8.16%. It seeks to track the performance of the S&P U.S. Dividend Growers Index and has an attractive expense ratio of 0.06%, meaning that for every $10,000 invested, Vanguard only charges $6 to manage your investment on an annual basis. The next ETF we'll look at is SDY, or the SPDR S&P Dividend ETF. It has a dividend yield of 2.77% with a 5-year CAGR of 11.03%. It seeks to track the performance of the S&P High Yield Dividend Aristocrats Index and has a relatively high expense ratio of 0.35%. SCHD, or the Schwab U.S. Dividend Equity ETF, is third on our list. It has a dividend yield of 2.88% and a 5-year CAGR of 14.55%. It seeks to track the performance of the Dow Jones U.S. Dividend 100 Index and has a low expense ratio of 0.06%. If you want to strictly follow dividend aristocrats, which are companies that have paid their investors a dividend each year for the last 25 consecutive years, there's an ETF for that as well. Noble, NOBL, the ProShares S&P 500 Aristocrat ETF. It has a dividend yield of 1.88% with a 5-year CAGR of 3.77%. It seeks to track the performance of the S&P Dividend Aristocrats Index ETF and has a higher expense ratio at 0.35%. And for the fifth and final ETF, we'll take a look at SPHD, or the Invesco S&P 500 High Dividend Low Volatility ETF. It has a dividend yield of 3.72% with a 5-year CAGR of 11.61%. It seeks to track the performance of the S&P 500 Low Volatility High Dividend Index and has an expense ratio of 0.30%. Now, I only invest in one dividend ETF. Based on the high-level comparison we just looked at, which one do you think I choose to invest in?
I have so many questions.
Pause the video and drop a comment below to let me know which one you think it is, then keep watching to find out. No, really, drop that comment. I'll wait. Okay, so now that we know some of the more popular dividend ETFs, how do they perform when compared to each other? Let's take a look at the last 8 years to see how each one performed. The reason I'm choosing 8 years is to make sure they're all weighted equally, and this is the time period that includes all funds. We'll make it easy and only choose a one-time initial investment of $10,000 with no additional contributions. And of course, we're reinvesting our dividends since we know that's the best way to secure a solid return. So now let's take a look. After 8 years, VIG has an ending investment value of $27,600.83. That's a total return of 176.01%, which annualized over the 8 years is 13.44%. At the end of the 8-year investment period, SDY has an investment value of $24,388.39 for a total return of 143.88%. That gives us an annualized return of 11.71%. SCHD has an investment value of $29,184.91 for a total return of 191.85%. Annualized, that's 14.23%. Noble, ticker NOBL, has an investment value of $27,068.68 for a total return of 170.69% and an annualized return of 13.16%. And then our last ETF, SPHD, has an investment value of $21,560.05 with a total return of 115.6%, give us an annualized return of 10.01% over the 8 years. So as you can see, over this 8-year time period, SCHD performed the best for total investment value, total return, and annualized returns. While that is a good indicator of how these funds perform, let's take a look and see what happens if we hold our investments in those accounts for a longer period of time. Over time, the differences between each of the funds begins to grow and the power of the dividend snowball effect takes over. If you haven't already watched it, you can see my video on the power of the dividend snowball effect by clicking on the link in the top right or clicking on the link at the end of the video. Since we can't know how any stock or ETF will perform in the future, we have to take the historical values and project them in a linear fashion over time. Doing this, we can see a projection of what our returns might look like in another 10 or 20 years. So let's do that right now. You can see that after an additional 10 years or 18 years total, SCHD is still the winner for total investment value at $109,863.52. And it's paying us annual dividends in the amount of $4,261.05. SPHD continues to lag the pack in investment value at $57,655.64, while Noble is only paying annual dividends in the amount of $822.86. Now, if we harness the power of time and exhibit patience like I've talked about in my previous videos, and we hold on to these ETFs for an additional 10 years, so now we're at 28 years total since our initial investment of $10,000, SCHD has now reached $448,921.56, paying us annual dividends of $23,222.97. all on an initial investment of $10,000. That's a total return of 4,489%, and we're earning 232% of our initial investment each year in dividends alone. Now, let's look at one more scenario. Let's say after the initial 8 years of our $10,000 investment, we decide at that point that everything's going well, we see that we're making money, we want to start investing more. So we invest an additional $500 per month after the 8th year. So in 10 additional years, so 18 years total, 10 years of that investing $500 a month, we can see SCHD has grown to $227,586.32 with annual dividends of $7,189.05. Now, SPHD has grown its annual dividends to a greater amount at $7,799.46, but if you look at the investment value, it's only $156,352. Big difference. Now, let's finish out this last scenario. So for an additional 10 years, we put in $500 more a month. So a $10,000 initial investment for the first 8 years, and then for the last 20 years, we added $500 per month into our account. SCHD has now grown to $1,053,450.79, and it's paying us annual dividends in the amount of $44,696.98. Again, SPHD is paying us $65,822.94 in annual dividends, but the investment value is just a little over $600,000. It's 40% less than what we have in SCHD. As you can see from this, there is no doubt that ETFs can be a viable option for growing dividends and retiring early. Individual stocks do allow you the flexibility to review market conditions and invest in specific companies or sectors that may be advantageous at the current time. When investing in specific stocks, you need to analyze and choose companies based on several factors, including current financials and stock price to company value. I do believe that investing in individual stocks provides greater flexibility and control, but I definitely see value in holding an ETF for diversification and simplicity. Out of the stocks discussed, I currently own only one, SCHD. It currently makes up about 15% of my dividend portfolio. I like it not only for the historical returns and the forward outlook, but also for the easy diversification that it provides me. If you're just getting started in dividend investing, or you're looking for a way to add some sectors that may be missing from your investments, it's hard to go wrong with Schwab's premier dividend ETF. As always, please do your own research before making any investments to see if it's a good fit for you, your goals, and your personal risk tolerance. Keep an eye out for my next video coming out on Sunday that looks at what it takes to actually generate enough dividends to make your monthly house payment. Thanks for watching. Let me know in the comments what you thought about today's video and what you'd like to see discussed in future videos. I want to make sure that I'm putting out content that you want to see, and I really value your input. I'd appreciate it if you could leave a like and subscribe to the channel if this video helped you in any way. On the right, you can find my video on the power of the dividend snowball effect and my top 3 stock picks going into the end of 2021. I hope you enjoyed today's video. See you next time.